Imagine this. You walk into an electronics store. A brand new laptop catches your eye. The price, $1,000. You don't have that kind of cash today, but the salesperson smiles and says, "Don't worry, just use your credit card." One simple swipe. The laptop is yours. It feels effortless, almost magical. No pain, no sacrifice, no waiting. You walk out believing you've just made a smart financial decision. But what if I told you that the bank hopes you never pay for that laptop next month because the laptop isn't the product? You are. Every day, millions of Americans swipe their credit cards believing they're borrowing money. In reality, many are unknowingly entering a system designed to keep debt alive for as long as possible. And that's exactly why America's credit card industry earns billions of dollars every single year. Not because people are irresponsible, but because the game was designed long before they ever picked up the card. Why credit cards feel so good? Let's be honest, credit cards solve real problems. Need groceries before payday? Swipe. Medical emergency? Swipe. Car repair? Swipe. Plane ticket? Swipe. At first, it feels like freedom. You don't have to wait. You don't have to save. You don't have to say no. That's exactly what makes credit cards so powerful. But here's the problem. Human brains naturally prefer today's happiness over tomorrow's consequences. Psychologists call this present bias. We value immediate rewards much more than future costs. Banks know this. That's why every advertisement focuses on rewards. Earn cashback. Travel for free. Get airline miles. Zero annual fee. Exclusive VIP benefits. Sounds amazing, but notice what's missing. Nobody talks about 24% interest. Nobody says, if you carry this balance, this purchase could eventually cost twice as much. Because that's where the real business begins. The real product. Here's something most people never realize. Banks aren't really selling credit cards. They're selling time. Think about it. When you borrow $1,000, the bank doesn't expect you to become rich. The bank expects something much more profitable. They expect you to keep that balance. Month after month after month. Because every extra month creates more interest. More interest means more profit. To the bank, your debt is an asset. It's income. It's one of the most valuable products they own. That's why they make minimum payments look so affordable. $35 this month. Sounds easy. Sounds harmless. But behind that tiny number, a much bigger machine quietly starts running. The minimum payment trap. Meet Sarah. She owes $5,000 on her credit card. Her interest rate is 24% APR. Money is tight, so she decides to make only the minimum payment. Nothing unusual. Millions of Americans do exactly the same thing. The next month, her balance is slightly lower. She feels relieved. I made progress. But did she? Not really. Most of her payment never touched the original debt. It went straight to interest. The bank got paid first. Sarah got what's left. Month after month. The same thing happens. The vacation she took 2 years ago is already over. Her phone has been replaced. The clothes she bought are long gone, but the debt is still there. Quietly growing, quietly earning money for someone else. Transition. And here's where the story becomes even more disturbing, because interest rates are only one piece of the puzzle. Banks don't just make money after you spend. They've spent decades learning exactly how to influence what you buy before you even reach the checkout counter. That's where psychology becomes profit. Here's something fascinating. Banks don't wait until you're in debt to make money. They influence your decisions before you even spend. Think about the last time you opened your banking app. Maybe you saw a message like, "Congratulations, your credit limit has been increased." It feels like good news, almost like a reward. But ask yourself one simple question. Why would a bank voluntarily give you access to more money? Because they believe you'll earn more, or because they believe you'll spend more? The answer is obvious. A higher credit limit often leads to higher spending, and higher spending creates bigger balances. Bigger balances create more interest, and more interest means bigger profits. The bank isn't rewarding your discipline, it's expanding your borrowing capacity. The reward illusion. Now let's talk about rewards, cashback, travel points, airline miles, luxury hotel stays. These programs sound incredible, and sometimes they genuinely provide value. But here's the trick. The reward is designed to keep you spending. Imagine you spend $5,000 in a year. You proudly earn 2% cashback. That's $100. Feels great, but imagine you carry that balance for several months. At a 24% interest rate, you could easily pay hundreds of dollars in interest. You celebrated earning $100, while quietly losing much more. The reward wasn't free. It distracted you from the real cost. Why smart people get trapped. Here's something important. Credit card debt isn't just a problem for people who struggle with money. Doctors, engineers, lawyers, business owners, even financial professionals can fall into the same trap because the trap isn't built on intelligence. It's built on human behavior. Life happens. A medical emergency, job loss, unexpected repairs. One difficult month becomes 2, then 3. Soon, minimum payments become routine. And once that happens, interest quietly takes control. The real winner. Every month, millions of people celebrate paying their credit card bill, but the bank celebrates something different. Not that you paid, but that you still owe, because an active balance produces income. An unpaid balance earns interest. Late payments create fees. Extended repayment creates years of profit. The longer you stay in debt, the more valuable you become. That's why banks don't need everyone to fail. They simply need millions of ordinary people to carry a balance for just a little longer. Transition. So now we know how the system works. We know why rewards exist. We know why minimum payments feel safe. And we know how banks quietly profit from debt. But one question still remains. If the system is designed this way, how do you escape it? That's exactly what we'll uncover next.
Now here's the good news. The system may be designed to keep you in debt, but that doesn't mean you have to stay there. The first step is surprisingly simple. Stop making only the minimum payment, because the minimum payment isn't designed to help you. It's designed to keep your account active for as long as possible. Even paying just $50 or $100 more every month can dramatically reduce the total interest you pay over time. The goal isn't just to lower your balance. The goal is to stop interest from controlling your future. The snowball versus the avalanche. Financial experts usually recommend 2 strategies. The first is called the debt snowball. You pay off the smallest debt first. Each victory builds confidence. Each paid-off balance gives you momentum. The second strategy is the debt avalanche. Instead of paying the smallest balance first, you attack the highest interest rate first. Mathematically, this usually saves more money. Psychologically, both methods work. The best strategy isn't the perfect one. It's the one you'll actually stick with. What wealthy people understand. Here's something interesting. Wealthy people don't fear credit cards. They fear interest. Most wealthy people use credit cards as payment tools, not borrowing tools. They collect rewards, but they pay the full balance every single month. To them, the credit card is convenience. To the bank, those customers are actually less profitable. The most profitable customer isn't the richest one. It's the person who keeps carrying debt. The big lesson. Credit cards are not evil. They're simply tools. The real danger begins when a tool quietly starts controlling its owner. Banks aren't forcing people to borrow. They're simply offering a system that makes borrowing incredibly easy and escaping incredibly slow. That's why millions of hardworking people remain trapped for years. Not because they're lazy, not because they're careless, but because compound interest works against them every single day. Powerful ending. So the next time someone tells you, hey, just pay the minimum, remember what that really means. It means paying for yesterday instead of building tomorrow. The biggest trap wasn't the credit card. It was believing that small monthly payments meant real progress. Because sometimes the easiest payment becomes the most expensive decision. And maybe the real question isn't, can you afford to use a credit card? Maybe the better question is, can you afford to stay in debt? If you understand that difference, you've already taken the first step toward financial freedom.